Thanks so much. Yeah, exactly. This is great. So, as you know, we're going to be talking about financial budgets and financial reporting this evening. And so, if that's not where you're going, you're on the wrong plane. Time to get off right now. But if not, that's where we're going to be going. You got a little bit of introduction for who I am. As was said, I'm the head of the National Black MBA for Los Angeles. I'm a former Wall Street investment banker. I'm the co-founder of Principal Management Consulting, where we do financial consulting and marketing consulting for our clients. I'm a graduate of Harvard for their law school and their business school, and some of my contact information is there. It won't be there long enough for you to type it down, but you can go ahead and I have cards I can give out at the end of the class if anyone would like them. All right, so we're going to get an understanding of budgets and financial reports. This is the schedule. We're going to figure out key terms like ROI, EBIT, GAAP. We're going to learn tools to have relevant discussions and make decisions based on financial data. That's kind of the playbook. And my only rule for the class is that everybody has to participate. And you all don't seem to have a problem with that whatsoever. But there are lots of people who know lots of things in the room, and I want to make sure we get that. And I don't know about you, but I hate to be in a class where there's one person that talks at you for hours, and I don't really have that kind of stamina to talk to you for hours. So I'm going to talk to you occasionally and then ask you lots of questions. And if you know the answer, just shoot your hand up and answer it. And everybody can answer one question. And we're going to have a lot of questions that are kind of end of segment summaries. So I don't know about you, but like when I took those standardized tests, if I didn't know the answer, I just went with B. So if you know the answer for anything that's raised, just raise your hand and go with B. But we want everybody to participate, okay? I really appreciate that. I'm going to cover a lot of what people are looking for. So some people are looking for refreshers, acquisitions, looking for funding. Some people are looking for money management. We'll do a little bit of that. Forecasting is going to be a big part of what we're going to do. Reports and how to do them are going to be somewhat of what we do, and definitely budgeting. So I think we'll hit upon most of what people are looking for. Things that we don't, ask questions, and I'll try to answer them. We'll have a little bit of a challenge in that the information that you're going to learn today is really designed to be learned over the course of 6, 7 different classes. But we're going to do it all very quickly because you guys are super bright, I can tell that. And but to the extent there are gaps or we go too fast or too slow, whatever, just ask questions. Please ask me questions so you keep me on track. And as I go through things, I'm just not saying acronyms and formulas and you're like, yes, and you have no idea what you're talking about. Okay? Yes, you have a question.
Yeah, I was going to say.
Nice and loud, I can't hear you.
Okay, I was going to say, I didn't hear everyone, but no one mentioned anything about real estate, did they?
A number of people said they wanted to buy buildings.
Okay, I apologize, because
Okay.
I was wanting to build I forget what you call it, but a little house in the back of mine.
Okay.
And since that wasn't my primary reason for being here, I didn't mention it, but I thought I didn't hear, so I guess I just missed it, sorry.
Yeah, okay. All right. So I think we'll talk about acquisitions as well, at a high level.
Okay.
And again, this is not going to be deep dive, this is going to be high level stuff. But ask me the deep questions that you really want answers to, and I'll do the best I can to focus on that. And we have so to start off the class right in terms of asking you questions, who knows what these key terms are?
Return on investment.
Can't participate.
Return on investment.
So we got return on investments, we got earnings before interest and tax, and what's the last one? Huh? GAAP? She says, is that where you buy clothes? So we got clothes, imperfections in your teeth. Do you have any other thoughts about what it might be?
Generally accepted accounting practices.
Generally accepted accounting practices. That is almost exactly right. It's generally accepted accounting principles, but very close, very close. Good job. Again, they say that if everybody knows what's going to be happening, it makes it easier for them to understand. So here are the segments we're going to have. First is going to be a financial terminology segment. Then the next segment is going to be about understanding budgets, analyzing financial statements, and then understanding and forecasting. Those are going to be the major segments. In the end, if we have enough time, we will also talk about making good acquisitions and kind of what that entails. So, and it says glossary because we're just about to go through a number of terms. And obviously understanding the concepts of budgets and financial and key financial terminology, all that stuff is helpful. For the people who said, I want to make sure I can talk to my banker, if you can get hold of this terminology, that's really great because one, when they throw it at you, you won't be confused. And two, when you throw it back at them, they'll be like, oh, now I really got to perform. So try to get your arms around these things as best you can. So first thing, given that this is a finance class, is the definition of finance, right? And it can be a couple of different things. It could be money required to actually do something. It can be money at your disposal, and it could be the art of managing resources, right? So, and you can use it in different sentences, right? So, what's the sentence that you use when you say money required to do something? Use finance in the sentence when it's money that you need to do something with. Some of you already used it in your sentences. No, but use the word finance in that first block, huh? This is very simple. Huh?
You get finances to buy a building.
Yeah.
Financial loan.
Investment?
No, it's basically, I'll give the first one so you know what I'm talking about, because obviously I'm throwing you off. But the first one would be, money required to do something. I have to finance this purchase, right?
Okay.
I have to finance this purchase. I need the money required to make this acquisition. I need to finance this purchase. Money at your disposal. Use the word for finance in that.
Capital?
No, we're using the word finance.
Oh, fine.
A money line.
Huh?
A money line.
Money line, but go ahead.
I'm gonna go to my banker for some financial advice.
Close.
Financial assets.
But when, let's say, remember that song from the 80s? No romance without
Finance.
exactly money at your disposal. If you got no finances, you got a problem, right? And then art of managing monetary resources. I'll just do this one so we can keep going. You just got to figure out how you're going to finance everything. That's the actual thing. That's the actual activity of figuring out your finances, okay? Here's some other terms, and then the big boxes. And so everyone kind of just raise your hand and give me a definition for any one of the big terms that are there. Go ahead, Justin.
Well, asset would be maybe like a vintage watch, I guess.
Okay, so an asset, an example is a vintage watch. You got another example for asset?
A home?
A home, right? So an asset is something that is kind of usually tangible, not always tangible. It's something you can feel and touch that you own or possess, right, or control, right? So that's an asset. Go ahead, Cynthia, with your example, quickly.
Oh, I was gonna say liability.
You can do liability.
Liability is the person that will be held responsible.
Exactly. So the person liable for something is the person that's going to be held responsible. And so if you have a liability, you're generally responsible for taking care of it. If it's the debt is a typical liability.
Credit card.
Or a credit card, and you have to take care of it, which means you have to pay it, right? Ultimately. Who's next? Yes.
Budget,
Yes.
the amount of money I have to spend on my expenses.
Exactly. On a go-forward basis, right? Anything else? What are the other ones? Quickly. Everybody knows these. Glenda, this is really easy stuff.
I can do equity. Equity would be the value of the balance of what is owed. Let's say you have a property 500,000
Mhm.
and you only owe 300,000, so the equity would be the $200,000.
Exactly.
The difference between the balance owed versus how much it's that value of that thing.
Right. So it's the value that you really own. So if you have an asset and you have liabilities, It's the difference between those assets and those liabilities. That's your equity. That's how much you own. So exactly your example is great. If you have a house worth $400,000 and you have a mortgage worth $300,000 on that house, then your equity is going to be $100,000, right? Because it's the difference between the asset and the liability or the debt associated with it. Last two. These are simple stuff. Anybody can do this. Come on, raise your hand. Somebody, yes.
Income,
Income.
the money that comes in from a specific source in the business.
Okay, exactly. And the last one?
The money coming in and money going out.
Cash flow, exactly. And it's the cash going in and the cash going out, right? And so what's the difference between cash flow and income?
Cash flow is going out, income is going
Cash flow goes in and out, yeah.
Cash
Once-
flow is the actual, I guess, excess of after you paid everything. Let's say, for instance, if you're renting out your house
Mhm.
for $1,200, your mortgage is $1,000. 200 of that would be considered your cash flow.
Okay, you're getting at it. But there's
It's
a
your
there's a
net
key
income.
there's a key difference between cash flow and income and
And
expenses.
after all of
Net
the
income?
expenses are paid.
Okay, so what's the difference though? Yes.
The cash flow is activity, and the activity, showing activity, and income is, is profit.
Okay, well, I think everyone's dancing around it, but the real differential is income, and especially net income, is something that you use accounting techniques like GAAP to calculate. Whereas cash flow is the actual dollars that are going in and going out. So we'll talk about this in a second, one of the things that you'll see when you look at your income statement is that there are non-cash items on your income statement. How many of you either own homes or know people who own homes and know anything about owning homes? So most of you probably know what depreciation is, right? We have that on the list, right? Depreciation is the amount that you can deduct on your taxes, right? That flows through your income statement and reduces your net income, but from a cash standpoint, it doesn't happen, right? You're not actually paying out the cash. And so the difference between your cash flow and your income in that scenario is going to be a non-cash item like depreciation. Everybody get that?
Yes.
Okay. And so we can run through this other list right here really quick. So accounting, that's the process of actually putting together your books. A balance sheet, one of the financial statements, which we'll talk about in detail later. Capital. Capital is a confusing word because it can mean equity capital or debt capital. But all the sources of funds that are put into a business, be they out of your pocket or from a lender, that's your capital. Cash flow we talked about. Credit, tell me about credit. Huh?
You need it.
Right. So you're talking, and you need it for what? Right.
You need business credit, you need personal credit.
Exactly. So you're talking about money that people will lend to you, right? Okay. And so I have that here, credit from lenders, right? What's this next one? Credit accounting. What is that all about? Yes.
It's a positive transaction.
Is it a pot?
It is a positive transaction. Like a deposit. Is it-
Yeah, you're getting to it. Can anybody help her out? So one of the things you'll hear your accountant talk about is that on your balance sheet, they'll have a credit entry or a debit entry. And so they're different accounting entries, right? And so on one side of the balance sheet, which we'll talk about, it makes the number go up. On another side, it makes it go down. I can never remember which is which. But the point is that these credits and debits are changes that happen to a balance sheet that make the accounts move one way or the other, okay?
Credits go up, debits go down.
On one side of the balance sheet, on the other side, they do the opposite,
Right.
which is why it's so confusing like that. Okay, we talked about depreciation. We know what expenses are. We'll talk about financial ratios. And then we have net income, which is different than income. What's the difference between net income and income? Very simple. Yes,
Net income is the bottom line.
exactly. So income is the amount that you get at the top, then you deduct what?
The gross.
The expenses, and then you get down to net income, right? All easy peasy stuff, right? Okay, great. Okay, and then this next slide says, who are the key players that are making all this stuff happen, right? And so we have, again, all easy peasy stuff, you know this stuff. There's a CEO who are all the people seated here, who are actually running the company. You steer the organization overall. Then you have a CFO, who you say, make those numbers right, and hopefully that person actually does. Then you have accounting, which is the collection of the financial data and the process of putting together the books. And then creditors, who determine if the company is worth being lent to from their perspective and who actually lend out the money, right? All easy peasy stuff. Any questions on any of that?
Yeah,
Yes.
just
Justin.
I want on the CFO and the accounting. If you hire like a public accountant, can you put that as your list of like officers?
Typically not. So part of what you want out of especially if it's a certified public accountant, is you want an accountant that comes in that is independent from the company. So I didn't answer your question exactly right. So there are two classes of accountants. There's an accountant that works internally as part of the company, and that person, if they give you permission, even if they're not your employee, you may be able to list them as part of your management team. And then there are accountants that you want that work outside the company, who look at the numbers that are put together by the people who work within the company and certify to the world that those numbers are good. And so those people have to remain independent. Does that answer your question? Okay. Any other questions? So then we have these general accepted accounting principles that we talked about before, right? And so why do we care about these rules? Well, because those are the rules that your accountants put stuff together for you on. And if you don't have a good semblance of some of the major rules, it makes it harder to understand what they do. So there's probably, of all the things on this slide, there probably one thing that really makes a difference is when revenue is recognized, right? So let's say you're putting together an income statement, right, which we'll do in depth in a little bit, and you have a 3-year contract worth $100,000. Do you show all $100,000 in the year that you won the contract, or not?
No.
Why not?
Because you didn't earn it in that year.
It's a 3-year contract, right? Exactly. And so the generally accepted accounting principles tell you when revenue is recognized. And so you win the contract, right? And you win the contract towards the middle of the year, right? Do you show a year's, and it's a 3-year contract, do you show the first year's worth of income, or do you show just half a year?
Half of the year.
Or whenever your company's date of organization comes around. So some people are in January, some are in June,
That's a good
some
point,
are
yeah.
quarterly.
Exactly.
So it depends upon when
Right.
you're established.
So the point is, that's very right, Jerry, thank you. And so the point is that the accounting rules tell you when and how you recognize your revenue. Just because you have a contract saying you made the money, even if they gave you a lot of the money up front or none of the money up front, that doesn't necessarily mean that you put that large amount or zero in your financial statements. So there's rules around that kind of stuff, and they're important to know. And I'm going to just give you one other example. Who here makes mortgage payments? Anybody make mortgage payments? Right. And your mortgage payments comprise of two different things, right? One is interest and principal and interest, right? Everybody gets that, right? Because you're like, what is this stuff I gotta pay? I gotta understand what this is. So if you were putting together your own personal income statement based on your life, how would you show that that mortgage payment? Now, so let's say it's a mortgage payment, $300 is principal, $300 is interest, $700 is principal, right? Because the interest is usually smaller than the principal. So how much of that $1,000 payment would show up in your personal income statement? 7, which portion of it? No. You could try. There's only one.
Then I didn't understand.
Okay, so again, we have a payment, and I should write it down because I'm getting myself confused with the number, right?
Good.
So we have $1,000 payment, right? We have $300 principal, $700 interest.
They will both show up, because you have to.
So in your personal P&L, how much of the $1,000 shows up? That's the question.
$300?
$300.
$300 is.
$300 is one answer. Everybody agree with that? $300?
I do.
Okay.
I'm thinking,
In fact, it's just the opposite.
oh,
In fact, the only thing that would show up in your personal P&L would be the interest. Because the interest is the current expense. The principal is a reduction of a loan, and the loan shows up on your balance sheet. And so the interest goes through your income statement. The principal reduces the amount of the loan on your balance sheet. And so they're separated up in two ways, and this is all because of these generally accepted accounting principles. So, you know, I do financials for my church, at least I used to. And it was always very confusing to them because they knew they were paying X amount of dollars for these mortgage payments, but when I showed them the income statement, it wasn't all there. And they were like, well, what's going on? We're paying more than that. And this is the reason why, and it's the general accepted accounting principles. So, so those are things to know. So this is the first review. I told you there's going to be lots of reviews. So this is the first review, going through the things that we talked about. So what is not a part of the definition of finance according to the dictionary? Money required to do something, business or art of managing monetary resources, the money at the disposal of an organization, country, or person, the totality of money earned and spent by an organization, country, or person.
D.
Huh?
D.
You say
D.
D is in David?
Yeah.
Exactly right. Exactly right. Everything else falls within the definition based on what we talked about.
what does totality mean?
It means all of it, all around. Okay, which of the following is not on the list of commonly used financial terms that we saw earlier?
You skipped number 2.
Yeah, skip number 2 because
Oh,
it's
okay.
kind of complicated. Some of these questions are so subtle, I didn't want to
Okay.
get you twisted up for no reason. So we're on number 3 now, huh?
See, that,
Exactly, it's B, balance. But good try, thanks so much. Which of the following is not on the list of commonly used financial terms?
Gross.
Exactly, gross. And what's the role of the CFO?
Financial data, it's accurate.
So it says, use the financial data to steer the organization, ensure the financial data is accurate, use the financial data to control budgets, use the financial data to manage their areas or business units.
C,
D. D. D.
So we have a B, we have a C, and we have a D.
C. B as in boy.
Sure.
B.
50%.
It's B. As
B.
in boy.
C.
Actually, the answer to this question
A.
is A.
Wow.
So they put the,
Oh, they put together.
They use financial data
They
to
put-
steer the organization.
Oh, yeah.
yeah, so the CEO is supposed to steer the organization.
That's what Poppy was
The
steering.
CFO was, yeah.
Okay.
Like I said, some of these are subtle. All right, what's the role of the board of directors? How many of you are going to have a board of directors in your company? Everybody should raise their hand. Everybody should raise their hand. Everybody should, as quickly as they can, have a group of people who help them manage the company and give them insight above and beyond their own notions about what the company's supposed to have. So what is the role of the board of directors? Do they use financial data to determine how well the organization is doing and hold leaders accountable for meetings and budgets and other obligations? Do they use it to determine if they want to purchase stocks in hope of a great return? Do they use financial data to determine if the company is capable of paying back a new or current loan? Or do they collect the financial data and record it daily in computer systems?
D.
You say D?
They collect the data and record the data. That's not their job.
Do you have anything from D? Any other? Huh?
A.
A. A is the answer.
Yeah.
So the board of directors, remember, they're not operators of the company. They provide oversight for the company, and they give advice to the management of the company.
Right.
But they're not doing anything in the company on a day-to-day basis, okay? And we already went over what GAAP is an abbreviation for. Which of the following is not included in GAAP rules? Revenue recognition, balance sheet item classification, new accounting tendency considerations, or outstanding share measurement?
It's C, right?
Exactly, C. C is the answer. So the gap doesn't have anything to do with new rules and thinking about it and what's gonna happen. When people make new rules, it changes gap, but gap doesn't think anything about it, right? So it's all about revenue recognition we talked about. It's all about balance sheet items classification, saying what's the debt, what's the liability, what's an asset, those types of things, right? And outstanding share measurement. Within the gap financials, it will tell you how to measure the shares of the stock that's outstanding. Next is going to be understanding financial statements. And we're going to look at balance sheets. We're going to do a quick exercise. We're going to look at income statements, do a quick exercise. We're going to talk about statement of retained earnings and cash flows. Annual reports are things that exist, but they usually exist for much larger companies, so we're going to put that aside for today. So balance sheet. As it said, we're required by GAAP. It includes assets, liabilities, and the level of debt. It's a summary of what you own, what you owe, and what's really yours. What you own, like your house, what you owe, like your mortgage, and what's really yours. The difference between your house and that mortgage, right? Everybody get that? That's the summary. And so, what big item's not on here? That's a major part of a balance sheet.
Income?
Income is the income and loss statement, or the profit and loss statement. So it would not be on the income statement. I mean, not on the balance sheet. Any other guesses? Good guess.
Retained earnings.
Retained earnings. Exactly. Retained earnings or equity. Equity's not there. What I'll say about a balance sheet is, why do they call it a balance sheet? Why is it a balance sheet?
Because it's plus and minuses.
Plus and minuses in terms of what you owe and what you don't owe. Yes, that's headed in the right direction. Can somebody clarify that just a little bit more?
Is balancing the money, I think?
Huh?
Balancing your money?
Getting there. Who said it has to balance? So Ingrid, you said it has to balance. And what does that mean?
At the end, it has to, your losses and your profits, it has to balance out.
Not your losses and your profits, but your assets.
Expenditures,
Your asset, no. Expenditures, that's all income statement. Okay. You have the right concept. But your assets on one side and your liabilities and your equity on the other side, they have to equal exactly the same thing.
Right.
And if they don't, for a person like me that spends a ton of time on spreadsheets and figuring things out and projecting stuff or whatever, I know I got it wrong when my balance sheet doesn't balance.
Gotcha.
I have 2,493,000 on one side, 2,492,000 on the other. I'm like, darn, I missed it by $1.
Right.
So I have to figure out what's going on. And so, and we'll look at this in a second, but you can think of a balance sheet as assets here, liabilities here, equity here, and despite my horrible picture, this side and this side have to match. That's what has to balance, and that's why it's called a balance sheet. So on the asset side, we have cash, we have accounts receivable. Who can tell me what accounts receivable is? It's a term we haven't used yet. What are accounts receivable?
Who owes you money?
Money coming in.
Money
Money owed to you.
Somebody said money coming in, but the real answer is
Money owed to you.
right, because sometimes the accounts receivable don't come in. They're just, it's a list of who owes you what amounts of money. Okay? Supplies, that's an asset. Building, that's an asset. Land, that's an asset. Then over here, we have accounts payable. We haven't talked about that. What's accounts payable?
Oh, bills you have to pay out.
Payment you have to pay out.
Exactly. That's a list of things that you have to pay out. Yes, ma'am.
I'm sorry, my question is almost like hers. When you say supplies, are you speaking of purchasing supplies or supplies that's on hand?
So, because this is a balance sheet, it's a snapshot in time. It's a snapshot in time. So, even when you say purchasing supplies, that implies an activity of something that's either happening or going to happen. But this is a snapshot in time to say, what is the situation right now?
Okay.
Okay? And so, so the supplies are the supplies you have on hand today. Okay? I'll keep going and then I'll come back. So we have capital. Now capital again is a confusing one because is it equity capital, is it debt capital? We're just gonna assume, given where it's placed, that this is some sort of equity capital because it's the bottom side of the balance sheet. And as I said, in this little weird box that I have here, assets on the left, liabilities on the right up top, equity on the bottom right. That's kind of how it's laid out. So because this is laid out on the bottom, we'll assume it's some sort of equity capital, more equity, and other capital. So 3 different tranches of different types of equity. Yes, ma'am.
I think it's a little misleading because on the sample balance,
Can't hear you.
I think it's a little misleading because on the sample balance sheet, under fixed assets, it says equity and other investments. But when you look at the total under the liabilities, there's nothing that says equity, well, it says owner's equity, so you don't know which one it would fall under.
And that was my mistake, that's the only mistake I had.
Say what you said again, now that I'm looking at it.
So when you look at the sample balance sheet, under fixed assets, it says equity and other investments.
Under fixed assets?
At the top, under fixed assets, it says equity and other investments.
The third highlighted column, fixed assets.
All right, well, so it says fixed assets, so what's your question? I'm sorry.
It says equity and other investments. Then at the bottom, it says equity twice. So equity's in 2 different places. So if I'm using this as a model, then equity could go on either side, and I'm trying to figure out how to balance out.
Okay, so if you have equity and it's an asset, i.e. something that you own and control, then what does that mean? That's your question to me, right? What does that mean? So it says equity and other investments. So it's telling you that this is an investment in something else. So here's your business, but your business has, a building, it has supplies, and it has stocks and bonds, which could comprise equity in some other company or investments in some other company. And so if you have an investment in another company, in the equity of another company, then that would show up on your balance sheet on the asset side as an asset. Whereas the equity you have in your own company always shows up on the liability side. Does that make sense? So really think of that equity more like an investment than the equity of your own company. It would have been clearer if it didn't say equity and investments, if it just said investments. Because clearly an investment can be debt, it can be equity, it can be mortgage-backed securities, it can be all kinds of things, right? Does that make sense? Okay. Let's get to the question that Lindia had, which was the example said building and land, but it didn't say was there any mortgage on the building, it didn't say there was any land. So, exactly. So, it's a simple example, but if it has building, if it shows building, then the building itself is an asset. The mortgage associated with the building, if there were one, would show up over here as a liability, as a debt.
Oh, okay.
So because it didn't say mortgage, that means there's no mortgage. Because the mortgage on the balance sheet shows up separately than the asset that the mortgage is tied to. Does that make sense?
Yeah.
Okay, does that make sense?
I just wanted to know if we owned the building or not.
Huh?
I got you, I mean, I understood it, but I was just basically trying to figure out, am I owning this building, or am I leasing this building, or,
Right.
where does it go? So
Right.
it didn't say that when it listed on the sheet, but okay.
Yeah, and even if you were leasing the building, it would still, depending on the type of lease, it would show up as an asset. Yes, Justin?
Why is capital on the liability side?
Because capital is usually going to be either equity capital or debt capital. So if it's debt capital, it would show up here as debt. Because it's equity capital, it shows down here with the other forms of equity. But capital is, whether it's debt or equity, are the dollars that are put into the business by someone, either you or the lender. And they always show up on the right-hand side. All good?
Yeah.
Okay. So now we're talking about income statements. So moving on to the other major statement, right? So we have, and this shows income from sales, income from interest, income from investment. And it says the other name that you can call an income statement is a profit and loss statement, right? So what's missing from this slide in terms of income statement? Excuse me?
Shall the profit.
You say taxes? That's a category of what's missing, but there's like a big chunk. Excuse me? So we have income, right?
The profit, where's the loss?
Yeah, so, exactly, expenses, right? So you can't have an income statement unless you have expenses, income and expenses, profit and loss, right? So,
But you're just talking about profit.
hmm?
You're just talking about profit there, though.
Yeah, so from here, it looks like it's top line income before you even get to the expenses. That's the only thing that's listed on the
Yeah.
slide. And since we're talking about expenses now, what are the two main types of expenses that businesses have? Big categories I'm talking about.
Building,
Inventory?
Well,
Rent.
should say again?
Rent.
Rents, mortgage, but really big categories.
Employees.
Payroll.
Operating
Right.
expenses.
Employees.
Operating employees. Okay, so you're never gonna guess this. So I'm gonna tell you. And it's not because you can't guess this, because I didn't really phrase the question very well.
Okay.
Very artfully. But the two major types of expenses that a business is gonna have is gonna be its cost of goods sold, or its variable expenses, or it's what you call SG&A, sales, general, and administrative expenses, which are generally its fixed expenses. Everybody follow me? So variable expenses, which are characterized by the cost of goods sold, generally, and your fixed expenses, which are also oftentimes called your SG&A, sales, general, and administrative expenses. So let's think about a car company, right? So a car company, every single time they sell a car, they have to sell the labor associated with the car, the metal, the parts, the shipping costs to bring stuff over from Japan or China or wherever it's coming from, right? All that stuff. So for every single car they sell, that expense goes up. 10 cars, 10 times the amount of those types of expenses. Those are variable expenses, right? That's the cost of goods sold. So every single time they sell one, they have to bear that cost. Then they also have to have a big plant in Detroit. They have to have a 401k plan. They have to have all kinds of stuff symbolizing expenses that don't really change as they sell more cars, right? And so that's more the SG&A and the fixed expenses. Everybody kind of gets it? Okay. And so when you have huge fixed costs, like a big automotive plant, where the cost of that doesn't change, then you have to make sure you sell a whole lot so you can actually be profitable, right? Okay. And the difference between the income from sales and the cost of goods sold is a concept called your gross margin, okay? And your gross margin is how much profit, how much income you make on each sale. Everybody with me?
Yes.
Okay, great. So this is the results of the income statement. So you see the different income items. We have the commissions earned. So this is some kind of company, maybe an insurance agency or something like that, where they live off commissions, maybe a real estate company, live off commissions. Commissions earned, interest income, and fee income. And those are the three types of income. And they total it up for total income. And then for the expenses, we have wages, taxes, insurance, dividends, utilities, depreciation, equipment rental, etc. And usually dividends would go further down. They would go after net income, but that's okay for this particular example, all right? And the one thing I wanted to just point out here is, remember we talked about the fixed and the variable expenses? So as it is in the example that you have, if there were expenses specifically associated with how this money is earned on a variable basis, you have those expenses right here, and then you have a gross income line, and then you'd have the rest of the expenses, just like it is in the example. Does everybody kind of understand that?
Yes, sir.
Any questions there? The next statement is statement of retained earnings. And so on your balance sheet, it shows how much money that you've actually made over time, right? And the balance sheet, remember, is a snapshot in time. And so as of the time of this balance sheet, it's telling you what are your retained earnings. So it says, where did your retained earnings start? If you just started your company, it's 0. If you made money last year, you made $100 last year, it'll start at 100. Then it'll say, what's the new income and loss from this year's activity? Any dividends paid out to shareholders, and then the ending balance. And that's how this is calculated, right? And this information can show up independently, or it can show up either on the income statement or the balance sheet, depending on where it is. It usually doesn't show up independently unless it's a larger company. And what's important about this is, remember we talked about the balance sheet over here, we talked about the income statement over here. This is the place where those two things intersect, right? So your balance sheet is a snapshot in time. And so you can imagine the snapshot in time at the beginning of the year, the snapshot in time at the end of the year, and then the income statement activity that's happened between those two snapshots, right? And it flows in right here in terms of net income and loss throughout the year. Everybody get that? It's a really important concept. So this retained earnings place is where the income statement feeds into the balance sheet. Okay? Everybody with me? All right. Statement of cash flows. So usually when people are first starting to do financial statements, they usually do, whether they think about it or not, they usually do a cash flow statement. And because what they do is they look at their bank account. They're like, okay, I started with a bank account with X amount of dollars. I spent money for my business in this amount. I got checks in for that amount, and at the bottom of the line, my bank account grew by this amount, and that's my net income. That's kind of how people usually think about it, right? But because of the gap that we talked about, the income statements that are required for financial statements are different because of those types of items. Revenue recognition, splitting between amortization of a debt versus interest in the case of a mortgage payment, those types of things, right? And so the way a cash flow statement works when you're putting together financial statements is you usually start with your net income, and then you say, well, what are the cash flow from operations? And what you really mean there are what are the items the operating items that are non-cash that are associated with your company. So for example, you can start with a net income. You have a business that owns a building, right? You start out with a net income of, call it $1,000, but you had depreciation on your building of $75, right? And so the $1,000 minus the $75 gets you to what's the cash flow from your operation. So you start with net income and you back out anything that's not cash that's associated with your operation, such as depreciation. Everybody get that?
Yeah.
If you don't,
One more
tell me
time,
now.
one more time.
Okay.
Give an example.
Yeah, so again,
Can you say you start with net income and deduct
yes.
depreciation?
Yes. So my example, like I just said, is you have a company that owns a building. The net income for that company, based on the P&L statement that we just talked about, is $1,000. But as we saw in our example, why don't we use our example? That's even better. So the net income for this company is $18,700, right? But included in that is depreciation of $300, right?
1,000.
Depreciation.
$1,000, got it. So because of that, the cash flow from operations is $17,700 versus $18,700, right? Then, on top of that, if I can get my... Then on top of that, you have cash flow from investing, right? So if you buy another building, right? Or you buy something small, you buy some equipment that costs you $3,000, right? $3,000 worth of equipment, if you buy that, while the purchase of that equipment won't show up on your income statement because it's an investment, it will have a negative impact on your cash flow statement, right? So then your cash flow is $14,700. And then you can get cash flow from financing, right? So let's say you get a credit card loan for $10,000, right? So then, at the end of the day, your total cash flow will be $24,700. And at the end of the day, that's what it'll look like as the change in your bank account, right? And that's kind of how that works. So balance sheet reports. The summary of financial discussions from a meeting, the financial state of the organization, the plans for further financial actions, the cost of what is the money, the cost and what is the money spent on. Which one of these is right? Right, the financial state of the organization. Which of the following is not a part of the balance sheet? Assets, taxes, liabilities, capital. Easy. Taxes, right? Taxes. Because taxes are an expense, right? The company usually creates income statement. The companies usually create income statements monthly, every day, daily, weekly, every 6 months.
Well, it depends on the company.
It does depend on the company, but generally.
Every 6 months.
Monthly.
I would say every 6 months.
Monthly. A company that's making any amount of money probably wants to look at stuff monthly. And it's no coincidence that you get your bank statements monthly as well.
Okay.
So having your financial statements allows you to do reconciliation and make sure your bank statements are all working out, whatever. Okay. Which of the following is not an expense category presented in the income statement? Taxes, cost of goods sold, operating expenses, expenses expected in close future. D. D, right? You would say A. A, taxes are an expense. Okay. Which of the following which of the following does the statement of retained earnings not include? Beginning balance, ending balance, capital, dividends paid.
Dividends
C. It's C, right? Do you all have the PowerPoint? If you flip back on that page of the PowerPoint, you'll.
No, they have an exercise manual, but it still has the same.
Right. So trust me, it's capital, because capital is a balance sheet item, remember?
Yeah.
Okay. Where do the statement of retained earnings not appear? On a balance sheet, on informal documents, on an income statement, on a separate financial report?
Oh, no, it's not financial.
D.
That's it.
Huh? Answer is B. Nothing shows up on an informal document.
Oh, that's
anywhere right there. Everything here is formal, no informal documents. All right. Which of the following is not a component of the statement of cash flows? Cash flow from investing, financing, operations, the future expected cash flows.
It's
Future
not a
sales.
component.
D.
It's D, right? D. And if you notice, with these questions, some of them are trick questions, but anything that talks about the future of this or the future of that
It's not.
has nothing to do with your financial statements. Your financial statements are a report of the history of the business. Anything that talks about the future, we're talking about forecasting and budgeting, which is totally different. Okay, everybody with me?
So it's B?
So the answer that is incorrect is D. Right. D is the right answer. Which of the following statements is true? A negative cash flow is a definite sign that the company is near bankruptcy. A negative cash flow means there could have been a large investment. A negative cash flow means the company is doing poorly. A negative cash flow is not a reliable indicator of anything. E.
What?
C. Yeah, this is a tricky question.
D.
D.
Huh? So how many for A? Nobody for A. How many for B? How many for C?
C.
How many for D? How many are just tired and just trying to get Okay, the answer is B. It's a tricky answer, but and the reason why it is has nothing to do with finance. It's just the way this is like SAT stuff, right?
Yeah.
So
A negative cash flow.
exactly. So it says it definitely means something. It definitely doesn't mean
It's gonna be
anything.
a large investment.
This one says the company is doing poorly. Negative cash flow doesn't mean the company is doing poorly. There are, Uber which is this huge company, still hasn't made any money yet. Its cash flow is all negative all the time. Exactly. The negative cash flow is not a reliable indicator of anything. I would have said D, but the answer is B. Basic ratios that will help you analyze the financial statements of your organization. Income ratios, profitability ratios, liquidity ratios, working capital ratios, and bankruptcy ratios. Now for this particular group, we're not going to talk about bankruptcy ratios. I know that has nothing to do with you, totally irrelevant, so we're going to skip over that. And then I like the rule that we have over here. Warren Buffett's rule, never lose money. Number 2,
Anybody out there?
never forget rule number 1.
Tell
So just so it's clear, and it may be obvious, but just so it's clear. So income ratios kind of tell you whether or not your level of income for your company is satisfactory. Does it make sense? Is it working for you? Your profitability ratios, that tells you whether or not the bottom line is good. And even if your bottom line is positive, sometimes it's not positive enough, and you want to know what that is. Liquidity ratios mean that you're not running out of cash. So if you're one of these companies like Uber that is constantly losing money, right? You're not really too worried about your loss, but you are hugely worried about liquidity. Liquidity meaning you have the ability to pay your bills constantly. And so because they're losing money all the time, they have to be raising money all the time. And if they don't raise that money, then they run out of liquidity and then they'll go bankrupt, okay? Even though they may be, doing wonderful things. Working capital ratio is how much money is generated within your company. Working capital is the money that's generated within your company on a day-to-day basis to help you deal with liquidity issues, okay? And bankrupt ratios, everybody knows bankruptcy, okay? What about some income statement ratios? So net income, so the 3 that they have here are net income increases to pay increases.
Can I ask, what is a bankruptcy ratio, just so we know?
Oh, I'm sorry. A bankruptcy ratio is a ratio that predicts that you're about to go out of business.
Okay.
So, so there's certain ratios that make it clear that you're just about to go out of business. And really bad ratios from any of these other things are predictors of the same exact thing.
This is unrelated.
Yes,
Two
please.
companies have recently went bankrupt, Toys R Us, and but they didn't give us much notice, like days, and they're gone.
I would say a good one would be MoviePass.
Aaron Brothers.
Say again?
I think a good example would be MoviePass for bankruptcy ratios, because MoviePass is on the edge.
Exactly.
As far as their numbers, losing,
Right.
customers,
And
not
so-
assessing, value and cost and
Exactly.
everything.
And for all those companies, what I just said applies, right? You knew that their profitability ratios were negative. You knew that their liquidity ratios were probably very much strained. You saw those things, they reported those things quarter after quarter after quarter. And then eventually, because I've actually worked with a company where I had to pull the bankruptcy cord, at a certain point in time, you sit down at a table at a meeting, people around it, and you're like, is this ever going to work?
Gotcha.
And what bankruptcy does, not to spend too much time on bankruptcy, but
No,
what
I just
bankruptcy
don't
does
know.
is it protects you from your creditors.
Right.
And so at a certain point in time, you have to say, we need that protection, and that's what I Questions, anything?
Thank you.
Great, income ratios. So we have 3 of them here. The one that's probably most used is the one down here, but we'll start up here. Net income increases to pay increases, which shows the change in your net income as compared to the change in your salaries, wages, and benefits. Now, why is that a ratio anybody would care about? So changes in your income, i.e. before your expenses, versus changes in the salaries you're paying people and the benefits you're paying people. Why do you care about that? Money going out, right? Yes.
It's also, as the wages are going up, your margins become closer, and that can be dangerous if you don't
Exactly.
have enough resources.
Exactly. And for many companies, what's their largest expense?
Salary.
People, right? And once you hire people, you can fire them eventually, but it costs you a lot of money to fire people too. So it's something to pay attention to, right? So if your people costs are going up much faster than your income, you got to have a plan, right? But if somehow you're doing it the opposite direction, you should be feeling really good, right? That means the same amount of people are doing more to make money for you, so it swings both ways. Net income per employee, same type of concept, right? Net income divided by the number of employees. And so that gives you a slightly different look because maybe you have the same number of employees. Maybe here the salaries haven't changed, but the number of employees you have has changed because of the way you're managing your employees. So it's a slightly different take on the same thing. And then we have net income to assets, but really what I want to focus on is net income to equity, right? Which is your return on equity. Anybody ever heard of ROE?
Yeah.
Okay, so ROE is probably the most paid attention to ratio that there is. And it's that way because investors usually drive most everything, right? And investors want to know for every dollar that I'm putting in, what kind of annual return am I getting on that dollar? Because I'm going to compare that annual return to the annual return that I'm going to get from investment B, investment C, investment D. And so we like companies that have high ROEs because it says for every dollar you put into them, you're making a lot of money, versus companies that have low ROEs, which means that they can struggle and they can go negative. Everybody with me?
Yeah.
So return on equity is your net income divided by your common equity. Yes?
Is ROE different from ROI?
Yes, it's very different from ROI. We'll get to ROI, but totally different. So ROE is the measure used to measure existing companies. ROI is the measure used to figure out whether or not a new investment makes sense. Okay? Yes? For sure.
The ROEs is the net income divided by common equity?
Yes. Net income divided by common equity. And we'll talk about common equity versus all different types of equity in a second, okay? Then we have some profitability ratios here. We have cash debt coverage, which is cash flow from operations minus your dividends divided by total debt. Question? Got a question? Okay, cash debt coverage, your cash flow from operations divided by total debt. Your cash return on assets is how much cash are you making versus the amount of assets that you have for the company. Your gross profit margin, we talked about your gross profit being your income minus your cost of sales. So the gross profit divided by your sales tells you something, and then your cash return on to shareholders, which is really another way of saying your cash ROE. So your ROE is based on your income statement, bottom line. But we said earlier, because due to GAAP, there's a difference between your income and your cash flow, right? Because of non-cash items that are stuffed in your income statement, right? So the cash return to shareholders is the cash flow from operations divided by that equity. So that's really your cash ROE. And for companies where there are small amounts of non-cash items in their net income, doesn't make a difference. They won't look at this number. They'll just look at ROE. But for companies where there are really huge non-cash items, like a big manufacturing company that has lots of equipment, so lots of depreciation, they will look at that number because it will be very different than the number that they have for just a regular ROE. So this one here, why would anybody care about cash flow from operations over your total debt?
Show profitability, I guess.
For future purchases, we should say.
Huh? Show profitability, but that's the whole category, right? What are you gonna say?
I was just repeating what you were saying.
Okay. Oh, that's it.
Your ability to pay.
It's the ability to repay. Exactly. So it shows, it's a profitability measure, but it's also a measure showing your ability to repay your debts, right? And so if you can't do that, then you're certainly not going to be profitable. You're going to have a problem. Your cash return on assets, why is that important? What does that give you a sense for?
Growth?
No, not growth.
No?
No. So what do you use your assets for? What are your assets for in your company?
Operate my business.
Exactly. You use the assets, right, to make the money. You use the plant to manufacture the stuff to sell, right? You use your investments in, you use your people. That's not a good example. So you use your supplies and everything to make everything pretty and so that your marketing goes well. So again, you can sell and make money, right? And so the question for this particular ratio is, how well am I utilizing those assets? Am I getting a large return on my assets or am I getting a small return on my assets? I have an asset base that I've invested in with debt and equity, right? So I've invested capital to get these assets, and how much money am I making on those assets? And so that's one way to think about your business from a profitability statement. And what all these ratios are about is trying to figure out how efficient your company is. And then the other thing these ratios is about benchmarking, right? So if you have a certain return on the assets of your business, and you can identify 3 or 4 businesses that are like yours, but they have a much higher return, then that means they know something that you don't know, right? You're underperforming. And so you got to do some research, figure out what's going on. Everybody get it?
Yeah.
Okay, great. Gross profit margin ratio, that's an easy one, right? So the gross profit is how much you make on every unit sold, right? And so the fatter your profit margin is, your gross profit margin is, the more money you have to cover all your fixed expenses, right? The faster you can cover your fixed expenses and get to overall profitability. Does that make sense to everybody?
Yes.
And so that's what that's about. And then we already talked about what the ROE is about. Any questions on any of that? Yeah.
What's the difference in the gross profit margin and net operating margins?
So it's really a matter of the definition. A lot of times your gross profit and your net operating profit will be defined exactly the same way. And so you really have to see what the definition for each one of those items is.
Okay. But they're both going to be indicated
They'll be
as the
similar.
same thing.
Yeah, they'll be very similar. They'll be very similar. So assuming that the definitions are similar, they could be exactly the same depending on what the definition is. Okay, and the net operating profit usually deals less with big industrial companies and more with companies that are more service oriented. And so that's why there's a difference. Because this whole concept of cost of goods sales is really a manufacturing concept, even though the concept can flow over to more service oriented companies. Any questions? All right. Then we have liquidity ratios. And I would say, wait a second, please. So then we have liquidity ratios, right? And I would say this is something that you probably really want to pay attention to, right? Because the biggest danger that you have as a small business to having your business crash is running out of what? Money. Exactly. Running out of money, that is the total and complete enemy. There are lots of friends, your branding and your whatever and your good service and all the stuff and your strong, will to make it work, you overcome everything. Those are all your friends. Running out of money, that is your major enemy. And that's, if there's anything I bring to the table when I work with people, I'm very good at not running out of money. That's kind of that's my superpower. Okay. Never run out of money. At least not so far. All right, so here are some ratios to help you figure out how you're doing in terms of that. When we say liquidity, we're talking about not running out of money, right? The ability to continue to pay your bills. So first we have this quick ratio, which is your cash and marketable securities to your current liabilities. So everybody knows what cash is, right? Everybody knows what marketable securities are?
Right.
Stocks, bonds, whatever you can sell in the market and make money and turn into cash, right? So marketable securities is just about cash. It's a fancy way of one step away from cash, right? And then we have these current liabilities. So let's talk about current. What does current mean when you have it on the balance sheet? I probably should have talked about it when we were talking about balance sheets. What does current mean when you talk about a current liability or current asset? What does current mean?
Paying the rent, paying the phone bill.
right now?
No, not quite yet.
Is it right now?
Someone said right now, but
Up
that's
to
not
date?
quite right, you're getting to it.
The balance on a credit card, for example?
It's on the books right now, but it's not right now.
Outstanding.
It's an outstanding balance, but what's the difference between a current liability and
One that's
a
active.
long-term liability?
One that's active.
They're all active, huh?
Well, yeah.
Well, it's not due right now, when's it due?
End of the month.
Nope, not due the end of the month.
Short-term liability?
Short-term? Short-term, but what does short-term mean? Short-term current sentiment. No, what's the current liability?
Could it be a
Something that's due.
predetermined time ratio in which
It is a predetermined time.
that you agree to with another company?
No, it's not, it's written into GAAP what predetermined time is. Current liability or current asset is a liability or an asset that comes due within the next 365 days. It's
Oh, I
gonna be
see.
due before the end of the year, for within a year's time.
So current means within the
Current
year.
means within the
Like a
next
bubble.
365 days. That's what it means,
Like a
okay?
post-dated check?
I'm not sure where to put that on the balance sheet.
Something like that.
It sounds like a balloon.
So these
Sounds
current
like a
liabilities.
Sound like a balloon payment.
So these current liabilities have to be paid when?
Before.
Exactly, within the next 365 days. So it says, how much cash do you have as compared to your liabilities that have to be paid within the next year? And so that's what this asset or quick ratio is about, okay? So it's the quickest and dirtiest way to figure out whether or not you have a money problem, okay? Then we have the cash debt coverage, cash flow from operations over total debt. I think we talked about that. And then we have the debt income ratio, your total debt as compared to your net income. Total debt as compared to your net income. And so, why do we care about this?
The debt to income?
Your debt to income, yeah. So now your debt, and when we're talking about debt here, we are definitely talking about long-term debt, right? So it doesn't all have to be paid within the course of a year, right? You have time to pay it, right? Okay, and your net income represents the amount of income for what time period? Usually a year, whatever the period of the financial statements, but usually financial statements are a year. And so it says, so this debt to net income tells you how many years you have to make the income that you're making in order to pay off that debt.
Gotcha,
Does that make sense?
gotcha.
Okay. And so so you ought to be paying attention to these things, but who else do you think is paying attention to these things?
Lender.
Exactly, the lender. Lenders will want to know these ratios very quickly because all they care about is how they're going to get their money back, right? And if you can make enough money to pay back the entire loan within a year, right? So your debt to net income ratio is 1 time, right? You think you'll get the loan?
Yes.
Probably, right? However, assume all other things being equal, like no post-dated checks, none of that stuff. But all things being equal, you'll probably get that loan. Now, if it's 10 times, you think you're going to get that loan? No, nobody likes to look 10 years out in the future to get that money back. That doesn't feel good to anybody, especially banks. So it's a whole different thing. So that's why that matters. Any questions? So your current assets minus your current liabilities, that's your working capital. We talked about what current means. And so if you have, and so really what we're talking about here is, it's all your current assets and it's all your current liabilities. But what you want to be making sure of is that each time you look at your balance sheet, your receivables, your accounts receivables, which are a current liability by definition, your accounts receivables are consistently greater than your accounts payable, right? Does that make sense? Mm-hmm. So the receivables that you have, that you're generating in terms of what money should be coming in quickly, are greater than the money that has to go out quickly. And so if that's the case, and you have positive working capital, you can add the other current assets in there, but it's really the receivables and the payables that drive this number. Everybody with me? Mm-hmm. Okay, so great. And then you have your working capital ratio, which is your current assets divided by your current liabilities. And so the greater this number is, the more room you have for liquidity. And the more liquidity room you have. So you want that number to be as high as it can possibly be. If it's less than 1, then you have a problem for the same reason that we talked up here. And then the working capital provided by net income, the working capital provided by operations divided by current liabilities. So that one pretty much says what's the working capital that I'm generating based on my income statement divided by the current liabilities that I have. And it tells you, again, how much room you're going to have in terms of liquidity. Does that all make sense?
Yes.
Okay. Yes.
Finishing writing.
Oh.
I'm left-handed, a little slow.
So then the next thing we have is advanced ratios and calculations for the analyzing financial statements. And so we were talking about a lot of current ratios. Now we're going to be taking a look at long-term ratios, more coverage ratios, leverage ratios, and calculating return on investment, which somebody brought up earlier on, the ROI, right? So here's some long-term analysis ratios. So your current assets divided by your current, it says your current long-term debt, but it's your current assets divided by your long-term debt, just to give you a sense of how those two things are moving together. Then you have your equity divided by your assets. And that's pretty much a leverage ratio analysis. So it says, of these assets that you have, how much of those are funded by equity? And the more it's funded by equity, the more financial strength your company has. So the more you put in your own money versus borrowed money from the bank, the stronger your company is because you can withstand losses. So if for every, and this won't happen to you, but if for every dollar that you have in the company, $1 came from you and 5 came from the bank, never happened, but let's say it did, then you can only lose $1 before the bank's all over your neck saying we're taking over your business. But if it's the other way around, $1 for the bank, $5 for you, you have a lot of room. And banks like that, and investors like that, because it means that you have quote-unquote skin in the game, and you really care whether or not this company is going to work out well, because if it loses, you lose, okay? Then we have your deferred debt divided by your tangible net worth. And so it's all of your debt, as a percentage of your tangible net worth. And your tangible net worth is your equity minus any intangible things that you have on your balance sheet, like, what's an intangible? Like your patents or something. You may put a patent on your balance sheet for however many dollars, but you can't, if your company's out of business, nobody cares about your patent anymore. It's not like a building that can be sold like that. Yeah. So those are some of the long-term ratios. And you look at the long-term ratios, right? Because it allows you to see from a longer standpoint the strength of your company, okay? Somebody remind us what EBIT is? Excuse me? Earnings before interest and taxes, that's what EBIT is, right? And so it says, what's that divided by your interest, right? And so it says, what cash does a company have divided by its interest, such that it tells you how many times you can pay the interest associated with whatever debt you have to keep the company moving. So sometimes if you're in a tough situation, the banker will say, okay, you no longer have to pay your principal to get you through this hard time, you just have to pay interest. But they want to make sure you definitely always have enough money to pay the interest monthly over time, because if you can't, then that causes them accounting issues, and they have to classify your loan as a non-performing loan, and as long as you're paying interest constantly, they can pretend that you're a good creditor, whether you are or whether you're not. So then we have some further leverage ratios. Your equity ratio says your equity divided by your total capital employed, and the total capital is going to be your equity plus your debt. So it's really saying what percentage of your overall capital is covered by equity. And it's the same thing we just talked about, where if more of your capital, if you have a higher percentage of your capital in equity, your company's financially stronger, everybody's happier because you have skin in the game. Then we have debt plus preferred stock over common equity. And so that is really showing how much debt you have as compared to equity. And I said earlier that we were going to talk about common stock versus preferred stock. All you really need to know about that is the common stock really is your ownership in the company. It's symbolized by that common stock. You can have preferred stock and it can be called preferred equity, and it shows up on the equity line, but it typically is, it acts just like debt. So it shows up on the equity line, it's called equity. It's subordinate to all your debt, which is why it's called equity, but it's senior to your common equity. And so in terms of who gets paid, can I erase this now? Everybody good? In terms of who gets paid, it's senior debt, sub-debt, preferred equity, and then common. Equity. And the money flows this way, right? And so if there's only enough money to get to here, then everybody from here down, they're just out of luck. SOL. Same thing here. If you got enough to get down to here, then these people are just out of luck, and it just goes that way.
Like
Okay?
the first, second, and third mortgage.
Exactly. And so this would be like the third mortgage, which never ever gets paid. So that's what they're talking about here. So they're saying all your debts, including this preferred equity, which really acts like a debt, as compared to your common equity, so we can see how much you have in the game versus other people. Because the preferred stock usually comes from third parties. You don't buy your own preferred stock. It comes to you from friends and family and people like that who are typical lenders. Then your current plus long-term debt, which is really all your debt divided by your assets, and it's pretty much the same thing as up here. It's the flip side of that same ratio. So these are just all leverage ratios. Yes?
For a lot of startups, they usually hold a certain amount of equity for key employees,
Sure.
maybe 15-20%.
Okay.
Is that typically preferred equity or common equity?
It really all depends on their lawyer. So, for the most part, it would probably be common, and this is getting into structuring stuff that you probably talked about earlier, but for the most part, it's probably common. Oftentimes, it will be a secondary form of common, which may not have the same kind of voting rights as the primary form of common. There's lots of ways to structure things so people can get the upside and not have the control. So when you're thinking about securities, probably talked about this the other day, the three things you really care about are upside, downside, protection, and control. So debt holders don't get any upside, they just get their coupon, but they get all the downside protection because they're at the top of the thing, right? And they don't get any control. In fact, they're prohibited from controlling the company. The preferred equity or maybe other types of common, maybe they get more of the upside. Preferred equity usually doesn't get upside. They usually just a lower form of debt. Different types of common, you might have a common that gets some of the upside, not nearly as much of the upside, and they don't get quite as much of the control, but maybe the price on it is less expensive than it would be for the other thing. So those are the factors that help you figure out what kind of securities you're going to issue.
Micro business enterprise, how relevant are some of these terms and objectives that should be viewed in a very first time small business? How relative is it?
I think for mom and pop businesses, and I have a few, I've owned a few, I think that certain ratios really liquidity ratios are important because you really do want to monitor how you're doing in your cash flow. I think that most of this stuff, most of the leverage ratios really doesn't matter because you're putting in all the money. For mom and pop businesses, you're not really getting a loan. And these concepts begin to matter as you begin to try to get money from third parties. And I think for the room though, it's pretty relevant because I don't think there's anybody in the room who's not looking, who wouldn't enjoy a little bit more capital in their business. I think everybody either has that or is planning to make that part of what they're doing. So, and lastly, return on investment, calculating return on investment. And it's the gains from the investment cost minus the cost of the investment over the cost of the investment. So what does that mean? And so it helps you determine whether an investment is worthwhile, whether it's worth the effort. And it's a good thing that's always good to do. So basically it says, am I going to get enough out of this investment to warrant what I put into it? And so in the simplest sense, if you make $1 investment in a company and you get $1 back, then you have to say to yourself, was it really worth even putting that $1 in? Because all I got is the same thing I had. I'm not behind, I'm not ahead. What am I doing? And then if you get $1, put $1 in, and you get $1.03, again, you have to say, well, I'm a little bit ahead, is it worth it? But then the one thing that they don't talk about in the slide, which is important, is the time value of money, which is you put the money in, if interest rates are at 10%, you put in $1 and you get $1.10 back at the end of the year, you basically haven't gotten any money back because you could have put that money somewhere else and got that same 10%. So this investment isn't doing anything for you than what you could do at a bank. Let's say banks really had 10% rates. I know they don't. Let's pretend they did. If that's all you're doing, then you're not really doing well. So the way to think about return on investment is that you typically make an investment and you get a series of small returns hopefully over time. And then at the end you can sell it or do whatever you want. You get a big return over time. And you have to calculate all that back, including the time value of money to figure out whether or not you've made a good investment. So the picture I like to draw, hopefully people can see this a little low, is you have you make a big investment, i.e. a downward arrow means cash out your pocket. Usually you do that, you have to wait a little while before you get anything. You don't usually get money the first time, so you wait a couple of years. And then you get some small payments across the years. And then you exit out of it and you get a big payment at the end. And you just really have to figure out whether or not this makes sense. And the return on investment analysis will allow you to do this. And the easiest way to do it is pretty easy. Once you understand the concept, it's pretty easy to do. If anybody has Excel or any kind of spreadsheet software, you can take that and put the cash flows in and just use the formula, and it will tell you what the ROI is pretty quickly and easily. So it's not very hard to actually execute. Questions on any of that? Okay, good. So so we're going to get back to our questions because I can tell people need to perk up a little bit. We're running around the 9:30 hour. It's getting kind of late. People are around the finish line. So which ratio calculation do we use to get the following results? The ratio determines the relative financial strength and long run. Which ratio determines the relative financial strength and long run liquidity of a company?
Which ratios? B or C? Probably
So someone says C, but C talks about current assets, so it can't be long term, right?
total debt versus net worth.
So total debt versus net worth, maybe B. Any other thoughts?
The stockholders versus equity ratio?
It's actually the stockholders' equity ratio.
One.
Yeah, because I looked at the answer.
I did.
Okay. So it tells you the financial strength and gives you some sense of the liquidity of the company. These are, these aren't the most easy, straightforward questions, right? Question 2 is too hard to deal with. Question 3, what's the name of the ratio calculation that we use for calculating coverage ratios? All right, I want to hear from somebody who hasn't said anything yet so far. Somebody way in the back. What do you think, way in the back? Come on, way in the back. Both sides, way in the back. Somebody, come on. No free riders in the class. Come on, come on, come on. What do you think? Glenda, Tanisha, Charlie, Cynthia, what do you think? Just take a guess. Huh? You say D? Time interest earned ratio. Okay, why? Okay. You said B? You said B?
Yeah.
Okay. And times earned ratio? Okay. Any other thoughts? What do you think, Crystal? Crystal knows the answer. She's just hiding out the back. Come on, Crystal. What do you think? Huh? So you said, what did you say? Yeah.
D.
D's the right answer. See? There you go. The times interest earned ratio. What does the coverage ratio show again? How many times a company's earnings can cover the fixed interest payment on its short-term debt. It shows how many times a company's earnings can cover the fixed interest payments on its long-term debt. It shows the earnings before interest and taxes. None of the above. B, exactly. Which ratio calculation do we use to get the following results? This ratio determines how much of the assets are financed. So how do we tell how much of the assets are financed at one point? Figure that out? It's the debt ratio, right? Because the debt is the financing, right? The debt ratio. Okay. What do the leverage ratios calculate? The proportion of the owner's contribution and the contribution from the creditors, the owner's contribution to the finance of an organization, the creditor's contribution to the finance of an organization. None of the above. Who said A? A, exactly. A's right. All right. Why is calculating the return on investment helpful for a job? Because it can practically make a financial decision instead of you. Wouldn't that be great? You just get a spreadsheet and all of a sudden you have to make a decision. Spreadsheets that I had to go. Because it can show the efficiency of investment, because it's an absolutely reliable way for presenting the investment to fail. Like if you can get a positive ROI, you know it's never going to fail. That'd be great. Because it will make you look wiser and more dedicated. D. I'm all for D, right? What's the right answer? B. Exactly, because it can show you the efficiency of an investment. Now, any questions on any of that? Okay, we're going to do budgeting. We're going to do it fast.
So before you do that, are there any questions on ratios? If John should stay on ratios, you can stay on ratios so that everybody understands what that would take in terms of loans or financing or anything like that. Any questions on how would that work with your loan? Or, anything like that. It's important for you to understand what he's covered right now.
How would that work for a loan?
Say it again.
How would that work for a loan?
How does it work for a loan? So basically, when your lender's going to ask you for a ton of information, and a lot of it's going to be financial, and they're going to ask you for your financial statements as the company is today and historically, and they're going to ask you for your projections of where they think the company's going. And then they're going to have, some 20-something analysts take that information and run it through and calculate a bunch of ratios that they figure out, they look at to see whether or not a loan fits within their qualifications. They have numbers, ratios, minimum and maximum ratios that they'll work with. And so if you fall outside of some of those ratios, they'll say, you're a great person, sorry, we can't help you. If you fall within those ratios, then they'll want to get to know you more personally and try to understand and get behind the numbers. But they usually use those numbers as a cutoff to see whether or not a business can start. And so what you want to do is you want to, one, calculate your numbers, and two, you want to have a sense of what those ratios are yourself, so you can see if it's something that we call bankable, something that a bank would be willing to work with. And once you know that, if it is, then you can go forward. If it's not, then you kind of say to yourself, well, I got to rethink this business model. The profitability is too low, the coverage ratios I think I'm going to have aren't really working, those types of things. You have to figure it out so that you can get to a point where your company is something that a bank would find attractive. And in terms of exactly what those numbers are, you can talk to various bankers to get a sense of what some of the key numbers are. We talked about the key ratios. In terms of the cutoff points, different banks have different cutoff points, but you can get some sense of what those things might be. But some of them are just obvious, right? So if you have no liquidity, you're not going anywhere. If your debt to net income number is super high, you're not going anywhere. So it's those types of things.
And we'll have someone in next week talking specifically about the loans and the loan process and what that looks like in that process. So they'll take you through what you will need, and as much as John's already been giving you, they're going to take you through step by step. This is what you'll need. This is what it might look like for a micro loan. This is what it looks like for an SBA loan. So, and you don't have to figure all these ratios out yourself. Remember in the first class, you talked about having a bookkeeper, having an accountant. That has to be part of your budget, which, if there's no questions, we'll have John go through the budgets and what that looks like.
Just one real quick, so,
Yes.
This part, the ratios and the financial part, you pay more attention on this than all the mission statements to get qualified for the loan.
Yeah, for bankers, they're going to first look at the numbers, then they'll start to listen to whatever your mission and vision and all that kind of stuff is. But that's just how they see the world. Now, for you as a business owner and making your company go, the vision and the mission is infinitely more important, because if there's no real motivation and driving force behind your company, then you'll never make the numbers. So, because the bankers want to see something, doesn't mean that everything else is not important. Does that make sense?
Bankers' stories are numbers, so your numbers are going to tell your story. Your customers and you, the story is in that mission and passion that you put out there for your business.
You had a question?
I did. I've always,
I'm sorry, you gotta be louder.
Louder.
oh, I usually don't get that. I would like to know, in your own words, how would you define ratio?
I would define it as a comparison of one aspect of your business to another aspect of your business that allows you to move beyond the surface of the numbers and try to understand the direction your business is moving in, positive or negative. So it's comparisons that allow you to get that second level of understanding your business within itself and compared to peers. That help? No? Nothing?
Yeah.
All right, understanding budgets. So common types, we'll talk about the common types of budgets, the information you need, who should be involved, and what a budget should look like. There are different types of budgets, and here are some of the different types of budgets that there are. So who can just give me an example for why some of these budgets make sense?
Oh, you gotta have a budget for marketing.
So you gotta have a budget in for marketing, right? So you need to know how much you're supposed to spend and how it's gonna work, right? Okay.
Gotta have sales, because you can't push anything without that first.
Right. So if you don't have a sales budget, how are you going to get your sales team, even if it's you, to know whether or not they're reaching the goals they need in order for the company to work right? So you got to have a sales budget. What else?
Production, product, if you don't have a product, you don't have a company.
Right, exactly. So Tesla, right? They have a production budget, which they continue to miss over and over and over again. They're supposed to make 1,000 cars, they make 800. But they wouldn't know that they're messing up if they didn't have a production budget, right? Oh, he's a billionaire, I'm not.
Your expenditure budget, you need to know what you're going to be spending in order to make your profit.
Exactly, exactly. And the expenditure budget is kind of the overarching budget that all the financial people who, don't care about vision or any of that stuff, all they know is, you're not supposed to spend more than this, stop spending more than this. And they always, the visionaries and the expenditure budget people always have clashes. What else? Have we gone through everything else?
Project and cash flow.
So what's the project budget all about?
What is the cost of your protections?
Say again?
Something specific that you're doing for your business?
Exactly. Within your business, you have a whole business operating, but maybe you have a specific activity you want to do. Maybe you want to change over from one software application to another. And that's a project. So you got to think about what's going to be the cost associated with that, how does it make sense, those types of things. And the last one's cash flow budget. And that's all about just, again, make sure you don't run out of money, right? Staying away from the run out of money. All right. Those are the types, common types. And, this is a complicated slide. What information do we need? What are the goals? How much money? What are the costs? What it's really all about, budgeting, what it's really all about is taking activity that you'd like to have happen and turning it into numbers, turning it into dollars, okay? So whatever you're trying to do, you have to push that down and figure out what are the dollars associated with it so you can plan that out. And that's what budgeting, projections, and forecasts are all about. Any questions on that? CEO to CFO to managers, operations, everybody, right?
Say who should be involved, kind of a general question.
Yes.
When we're creating this, let's say we have different departments, like who in the company would be tasked with, let's say, putting some of these financials together that we went over in the previous segment and some of the stuff we're talking about now. And if we have just ourselves, solopreneur, who should we be connecting with, whether it's a CPA or an accountant or our tax person, who should we be connecting with?
So in terms of putting together your financials, definitely it would be an accountant if you need to outsource it, or the accounting people who you have within your company. In terms of putting together projections, it's usually a financial leader within your company. You might have 6 or 7, let's say you have a mid-sized company, you have 6 or 7 financially oriented people in the company. It's really the financial leader that you want to be the person who's going to put together your projections, because they have the broadest view and they have the wherewithal within the organization to get other professionals in other areas of the company to cooperate to make it happen. Because if it's just a financial person that does a budget by itself, it's not going to stand up because they don't have enough information. You need the operators to really do that. If you're a solopreneur, you know all this stuff. You just have to be disciplined enough to get it done. And if you're a solopreneur and you've outsourced your accounting, you can also outsource putting together projections just based on people who know how to do that. Some accountants know how to do projections. Some accountants are more focused on historical and projections. And so you just have to find the right professionals who know how to do it. But there are plenty of them. Yeah.
And this is where you'd also go see your SBDCs that we talked about in session 1, where they can point you out to financial people to do your projections and help you understand your ratios, so that when you're talking to the bankers, you're speaking the same language and you can understand what you're telling them and then what they're telling you. So there's a lot of different resources that John had mentioned out there to help you walk you through those various financial steps that you're going to need.
Any questions? Okay, so what should a budget look like? Different categories, actual categories, projected categories, the difference between the two, but a picture is worth 1,000 words. So it should look a lot like an income statement, your budget should look a lot like an income statement, where you have what you think is going to happen here, this is the actual budget. Then you measure what actually happens versus what you think the budget is, and you figure out what the variance or the difference is. And by understanding what the variance is, you understand your company better, and the next time you do it, you can do it better. Bonus question. What kind of budget is this, of the types that we looked at? Which one is it?
What kind of budget is it?
Yeah, what kind of budget? Is it a sales budget? Is it
Income statement? It looks like a,
Like a manufacturing.
it looks like a marketing.
Real estate. Maybe.
It's a marketing.
Look at it, maybe.
Sample marketing expenses.
Expenditure budget.
The sales expenses, cash flow.
Expenses.
Exactly, it's an expenditure budget.
Expenditure.
Because everything here is an expenditure.
Okay, I see.
That's kind of how you know. And it's not focused on marketing, it's not focused on the project, it's expenditure budget. So how do you get these numbers that you're put in the budget? We saw what it looks like, how do you get these numbers? So taking a look at historical data, getting related information, adjusting for special circumstances, and then you put it all together. And then, it's better to use it with the computer. These slides must have been made in the 50s when computers were new and fancy, so it's still a thing. Of course you're going to do it on a computer. Historical information, use your historical financial information to help you figure out what's going to happen. You figure out the trends, and you can justify your budget by saying, well, it's what happened last year. But when I was in business school, they had a colleague, and he said using historical information to figure out the projections for your company is like driving your car with looking through the rearview mirror. It'll be pretty good for a while, but eventually you will crash. So definitely use it, but don't rely on it completely because there are lots of things that can change over time. So you have to be thoughtful. Gathering different types of information, you can get external information, internal information, staff requirements, new and existing policies. How can each one of these have an impact on the budget? So, for example, external environment. Tell me something in external environment that could happen that would change the budget or have an impact on the budget. Quickly now, quickly.
Accident at work.
Accident at work. Now, this is external. This is external, huh?
Earthquake.
An earthquake. An earthquake is definitely external, and if your company's near it and it collapses your building, that's definitely going to have an impact on your projections, right? So that's a good example.
Presidential election.
Presidential election. External. Try not to be political here.
Yes, right.
Internal environment. What could happen in the internal environment that would the CEO quits, right? Or maybe he gets I don't know.
Death of a CEO.
So for whatever reason, the CEO goes away, right? Happens to happen, right? And so that could have a big impact on the internal environment.
CFO, yeah.
Staff requirements. How does that have an impact?
If you don't have enough employees to do a job, you can't get the.
Oh, you gotta buy uniforms, you just require them, you have to buy uniforms.
So as the staffing that you have changes, right, then the budget's got to change. Again, for most companies, what's the largest expense? People, right? So you got to really pay attention to staff. And then existing policies. Tell me a policy change that could have an impact on the budget.
Yep.
No insurance.
Healthcare went from paper to electronic.
Okay.
Record keeping.
Okay. And so maybe that makes it less expensive.
Yeah.
And so all of a sudden your numbers are more rosy than you expected. And you said
No insurance.
no insurance.
Minimal insurance.
So you went from thinking that you could win without insurance to getting scared by what happened to your business next door, and you actually bought insurance, and so all of a sudden, now you actually have a shot, and you have to pay more money for it. Yes?
Quick question, how and why does it cost to fire an employee? I never understood why it costs to fire an employee.
It's really severance costs. That's the
Oh,
cost
okay.
associated with firing an employee.
Okay.
And then if you do it wrong, then there's suits and all that stuff.
Okay, I understand, okay.
Yeah, so, yeah. But severance is the largest cost. Okay, and then, you have to adjust for special circumstances, right? So, especially if you're looking at last year, and you're trying to figure out what happened last year, you have to think about all the different things. And this is kind of a rubric for thinking about what the issues are for special circumstances. But at the end of the day, what you want to do is build in a cushion. You want to build in a cushion for risk and for aberrations. And so, because some of the things that happened last year aren't going to happen next year, and we know that that's the case. And so you just want to kind of build that in. And then you want to put it together. You've done your research, you've acquired the information, you've kind of developed it all, you've adopted it to the new circumstances, and then you just want to report it out. And so that's kind of the process of putting together a budget. And let me just say, because it's not really in the slide, it's implied in the slide, but it's not actually said. And it goes to what Elisha was saying. It's getting late for me too. It goes to what Elisha was saying, which is that when you're putting together these budgets are made by people. And they're people within the throughout the organization. So if you have more than a 1 or 2 or 3 man shop, you really, and even if you only have a 2-man shop, you really have to get the people on board who know the information, which are typically not the same people who are facile with putting together numbers, to work together to make it happen. So like I said, I have a consulting company, I have a client right now, and the person who most knows the numbers is the person who's least interested in making sure the budget is exactly right? And intellectually, he knows that it has to happen. But, emotionally and spirit-wise, he's just like, I don't like that stuff. And so you really have to go through a process of getting people on board and making sure people understand and getting them to pay attention. Because if you don't do that, then you'll have, what a lot of companies end up with is a financial budget that's put together that the people who actually run the company don't know or understand. One of the things I used to do when I worked in investment banking is go to talk to people and talk to them about their projections. And so I'd be sitting with the projections of the company, which I've studied a lot, and I'd begin to ask senior management about those projections, and I'd ask them questions that they had no clue about because they weren't really involved in putting together the numbers. All they knew is the numbers showed earnings going like that. They're like, oh, that's great numbers. When I started to ask them some of the details around the number, they're like, oh, we got to call Bob. Bob did this. Like, who's Bob? He works in the cellar out back, but he's really good with a computer. And so, you gotta, as much as this is a numbers thing, it's really an organizational thing. So how to tell if you're on track, should your budget be updated, keep your diary of learning lessons, and when to panic. And when do you panic? When do you panic?
All red.
No, that's the wrong answer. That's not the answer. You never panic. That's, never panicking is one of the key things to keep you from running out of money. But in order not to panic, you really do have to plan. You really do have to plan enough so you can see that you're headed for the wall. If you can see you're headed for the wall a week before you get there, you can probably change course. When you really panic is when the bank shows up at your door unannounced. Then I get time to panic because the gig is up. So, what are you supposed to do to make sure you're on track? Schedule regular budget review meetings. Of course, the people that aren't involved in the budget hate these meetings, but you got to at least some periodic make sure people are in line with what's going on. Compare actual numbers with the budgeted amount. We saw that variance column. You want to make sure you're paying attention to that. Make sure the variances aren't large. And if they're really large variances, make sure you know the reason why.
That's
And when should the budget, and once the budget needs to be updated, what do? Well, you tell the right people that there are problems. So you can't be, especially if you're particularly focused on finance, or you have somebody particularly focused on finance, you or that person, you want to make sure that they don't feel like they can't tell you that there's a problem. Because if the people who are most looking after your financials don't feel comfortable telling you where there's an issue, then you will crash. And they'll know that you're going to crash, but they won't tell you, and then you'll just crash. So that's horrible.
Fire.
So you can't fire them once you're So tell the right people about the budget, or make sure the right people will tell you about the budget. Make decisions. Act. So you see yourself headed towards the wall, don't panic, because panic just implies that you're going to stand there and just right into the wall. Just take a deep breath, figure out which way to go, and work it out. And then continuously monitor the budget and exchange information with all the people involved. The more people you get involved, people don't like it, but once they're involved, they will try to help the company. And this is a slide about just making sure as you have issues or problems, you just keep on top of it. So you review or act, I don't know, so it's a nice acronym. All it really means is, don't make the same mistake twice. How do you not make the same mistake twice? You pay attention to it, and maybe you jot yourself down a note as to the issues that you had so you can pay attention to it. Or you can spread it within the organization so someone else won't do it. If serious situations arise, including accounting error, variance with lessons, external economic influence, or an earthquake, whatever happens, those are times it'll be really scary to you. But again, never panic. Just figure out what you're going to do and take strong corrective action. So that's all we have to say on budgeting. So any questions?
This is a lot of information.
I told you. I warned you. Look at the list behind you.
Yes, sir.
Look at the list behind you. This is what everybody wanted to know in the space of 3 hours.
But I want to be better prepared. I don't wanna just be, you know, the panic-stricken person.
Sure.
I wanna get the thing done.
Sure.
So I wanna make sure the top things are top.
Okay.
What are the top things?
The top thing is having a budget that is done by a financial person and is informed by operating people. That is the top thing. Not having a budget is a killer. So, and it sounds like a very simple thing, but it's the thing that a lot of people really miss. They'll put together financial projections because the bank makes them, but they don't really believe in the thing, and then they're not really paying attention to it. They're not managing to that budget. So really make a budget that you can really operate with and pay attention to it.
So we need an accountant right now.
Probably, if you're serious about your business, then you gotta have somebody who's helping you understand the numbers. If you don't understand the numbers of your business, you don't really have a business. I'm a numbers guy, so it's easy for me to say that. A marketing person would say, if you don't have a salesperson, you probably don't have a business, but I'm a numbers guy. You don't have someone that understands the numbers of your business. You have a hobby, you don't have a business yet. For the people who are interested in doing acquisitions, the last section we have is making smart purchase decisions, be it a building or what have you. And so, what are the things you have to take a look at? Here's some questions you need to ask. It says 10 questions, really only 4. Is the purchase budgeted for? Can you do without the item? What is the return on investment, i.e. the ROE that we talked about calculating? And what is the benefit to buying this item? So these are kind of key questions you need to know to make sure it makes sense. And then determine the payback period. So remember this line here in terms of you make a big investment, you wait, you get little returns, and you get a big return. It makes a difference if this big return is here or if it's way out here because of the time value of money. And one simple thing that people do is just say on a dollar for dollar basis, forget about the time value of money. How long will it be before using whatever this purchase is for, will I get my money back? How long is that going to take? And if it takes more than 3+ years, then you got to really look closely at it. Maybe 5 at the most. Something worth looking at. And it's different assets. If it's a big building, obviously it's going to take longer. But at least you have the value of the building at any point in time that you sell it. Then decide whether to buy or lease. We talked a lot about buying and leasing. And, you know, one key question is, do you have the money to buy it? Can you even buy it? Is that even an option? And then leases are full of tax issues, and so make sure you understand the tax issues to see which is better for you. And then, you know, when you're thinking about whether you buy or lease, you have to really think that you have to own the item. If you don't have to own the item, that makes leasing more attractive. If you have to own it, then that takes leasing off the table. And then is having a fixed cost something that's essential to you. You really want to have that, which is what comes with either one of those things. And then thinking outside of the box when you're trying to buy things, you know, use Craigslist, eBay, auctions, find out how to buy, purchase at the better level. Oh, you know, we saw the Warren Buffett quote from a couple of minutes ago. Warren Buffett is not, you know, as fabulously wealthy as he is because, you know, everything he touches turns to gold. He doesn't have the Midas touch. But what he does do is he knows how to buy things at a good price. He buys very low all the time. That's his consistent strategy. And so, and he buys low with the notion of how it's going to go up. And so with that, that's his basic strategy for making money. And so do the same thing. You got to buy something, make sure you buy it at the right price so the ability to get a good return on investment is enhanced. And so we talked about what the objectives were going to be today: identifying financials, understanding budgets, analyzing financial statements, understanding forecast techniques. Hopefully we've gotten the highlights of some of those. I know we haven't been able to go deep. Taking a look at your list in the back, we did talk about acquisitions, we talked about funding, not much about money management. We talked about financing and forecasting. Hopefully the glossary information, the definitions you got will make it easier to understand your banker at some level. We talked about reports and budgets, and at least we talked about how to know whether or not you're maximizing your profit. Not surprisingly, we didn't get to your SEC question, sorry about that. So hopefully we got to at least some of the things that were helpful for you. Thank you very much for the time that you've invested. Hopefully it's been worth your while. We certainly appreciate it. Oh, and by the way, I'm going to tell you again because it's our event. If you want to see some entrepreneurs that are really doing really good things, some of you are social entrepreneurs. We're going to have a woman named Olympia Ossett, who is an awesome social entrepreneur who's going to be at our event tomorrow night. So that should be great. If you are in the process of trying to get people to give you money and you want to know how the whole pitch process works, we have another awesome entrepreneur. His name is Chris Gray. He won on Shark Tank, so it's going to be kind of interesting to see it might be interesting to see what he might have to say about things. We'll have a number of financial people, so Bank of America Small Business Association is going to be there. Cadence Capital Partners, which is a private equity company, is going to be there. It's co-sponsored by the law school associate, the Harvard Law School Association, so you can rub shoulders with some of the smartest lawyers in the world, literally. And it should be a good event. Of course, I feel that way because it's my event, but I really do think it's something positive. If you want, we have a flyer here. You can get some tickets, and hopefully we'll see you tomorrow night. But either way, thank you so very much for spending the time. We certainly appreciate it.
Let's give